The pound has been hit hard over the course of the past week as borrowing costs surge towards the upside. The same thing's happening in the US, but we're seeing the dollar strengthen now with the latest US and UK CPI data coming out on Wednesday, the 15th of January. It provides the basis for a fresh bout of volatility for these two currencies. So first and foremost, let's look at what we're expecting for these reports. These are UK times, so obviously adjust accordingly. But what we can see here is there's an expectation that headline inflation in the UK will rise to 2.7 from 2.6. But core moves towards the downside, and we're going to get into the nitty-gritty of exactly how things are shaping up from a sort of base effects perspective that's going to influence this. As ever, I'm really going to be focused on those monthly figures, and the UK data looks a bit ugly from that perspective. 0.4 expected on both headline and core monthly CPI readings. That is a potential problem and would highlight the possibility that we're seeing resurgence in terms of inflation pressures in the UK. And it's not just down to those volatile elements such as energy. In terms of the US, we've got the core figure expected to remain at 3.3, but a rise in terms of that headline inflation rate to 2.9 from 2.7, with a 0.4 monthly figure once again coming into play for the headline monthly CPI. So all in all, it points towards a potential reflation coming into play. And that has been something that's been really dominating the headlines of late in different ways. So first, let's look at the UK inflation outlook, and we can see a number of different factors that go into this chart. First and foremost, the top end shows you that we have seen a sort of gradual resurgence in terms of core inflation in the UK. It's been less gradual and more steep when it comes to the headline number, which had got down to target in September, but now we've been moving higher up to 2.62. Now, we can also see in the mid part of it, of this chart, that essentially the big chunk of inflation took place within February, March, April, May. So there's an idea that once we get towards the mid part of this year, we're going to see inflation back to a relatively decent level. And that would be supported by the bottom section, which shows you that the last 6 months, if that's annualized out to a year, so if we maintain the trajectory of the last 6 months, for the next 6 months, we'll be at 2.45 for the core reading, 1.83 for headline inflation. And it points towards an environment where the Bank of England's able to operate. And so that ability to drive down interest rates will be absolutely key for the Bank of England. And there's question marks, right? Because the idea that we're going to see the same in the next 6 months as we have in the past 6 months is perhaps too simplistic, in part because of the policies imparted under the new Labour government when it came to raising the minimum wage, when it came to raising the cost of doing business or the cost of hiring by increasing the national insurance contributions from businesses. They are inflationary by nature. And so that points towards a possibility that we do see upward pressure in terms of prices in the UK at the same time that we're seeing energy prices start to turn towards the upside, and question marks about what's going to happen with the UK's relationship with the US. Will the US impart tariffs? Will it suddenly mean that the UK does the same in reverse? And so we start to pay more for US goods? Has the deterioration of cable provided the basis for us to start paying more anyway when it comes to US goods, because the US dollar is now stronger and therefore it's more expensive for us to buy goods from the US? So a number of different things that can provide the basis for upward pressure for inflation. And if we do see upward pressure for inflation, you're looking at the possibility of further upside in terms of treasury yields and further question marks around the UK economy. Now, it's notable that the UK and the US are both seeing yields move towards the upside. But instead of that rise in yields reflecting a perception that inflation is going to rise and that the central bank's going to hold off and therefore it strengthens the currency, instead people are selling the pound but buying the US dollar, because the US dollar inflation or the US inflation is led primarily by economic strength, whereas in the UK, that inflation move comes despite the fact that there's some question marks around the strength of the UK economy, especially with the potential breakdown in relations with the US. And so, we're talking about stagflation. We're talking about weak growth. We're talking about the possibility of higher unemployment, but we're not seeing a huge amount of that at the moment. And higher inflation. And when you've got weak growth and high inflation, it's not necessarily a great place to be. And that's in no small part highlighting why we're seeing this weakness for the pound. You can see here this upward trajectory of late in terms of borrowing costs surging towards the upside, and most notably reflected in the 10-year. And of course, we can see the different years attributed to the gilt yields, and the fact that the 10-year longer term duration is the one that's been rising the most. Really highlights the idea that this perhaps isn't necessarily just a reflection of where people think we are right now and within the next year, but instead something that is going to be structural for the UK economy going forward. In terms of wages, this is one element that we have, of course, been keeping an eye out on, because that is an underlying sort of factor or determinant and driver of UK inflation. And we can see here at the bottom end, we've got that CPI metric in green. But then we've also got the likes of that total weekly wages figure. It's the 3-month rolling figure that we've got there. And we did see a bit of a pop with the latest reading. So a potential resurgence of wage growth, that is something that could make us grow fearful of higher inflation. And when we're talking about the trajectory of the UK economy, well, over the course of the last year, or certainly 9 months, we've seen the UK services PMI moving towards the downside, and that provides the basis for weakness for cable, which is something that we have been seeing. But you can see this here, that services PMI moving closer towards the 50 threshold, and certainly, after a period of relative strength, we're seeing weakness there in terms of services. The question mark is whether that leads to services disinflation, right? And we're not necessarily in that position right now. And certainly with markets expecting 0.4 on that monthly reading, that would point towards inflation rather than disinflation. Now, the rise we've been seeing of late for the likes of euro sterling comes alongside the euro 10-year yield versus the UK 10-year yield. So we have been seeing this pop towards the upside, which is reflected in both the bond markets and the FX markets. And so, of course, we want to know whether we're going to see further upside in terms of that ratio between the yields, or whether we're going to see that rolling over. Now, certainly when we're looking at, say, euro sterling, we're looking at a region within the Eurozone where we're going to see rate cuts going forward. So the UK isn't necessarily going to be cutting rates. The Eurozone is going to be cutting rates, but we've been seeing a bit of a reversal of late. And the question mark is whether we're going to get back on that trajectory. Let me just throw up the likes of euro sterling for you to highlight exactly where we stand within this. So here's the chart for euro sterling. There we go. Let's go full screen. So this is euro sterling, and we can see we've got very clear downward trajectory that's been in play. And so, despite the fact that we're seeing sort of rising yields in the UK, we're also seeing rising yields over in the Eurozone as well. And a lot of that comes down to the possibility of higher energy prices. Of course, we're seeing this sort of move from Joe Biden just as he's leaving office, where he's essentially looking to put sanctions on a number of Russian oil companies and energy companies and ships and tankers. That's not too bad for the US because they're pretty much self-sufficient when it comes to the creation of oil and gas. It is a problem when it comes to the Eurozone region, and we've just seen the breakdown in terms of the transit of gas through Ukraine into Europe. So the UK and most notably the Eurozone is already in a pretty dire position when it comes to energy. And so we're going to be keeping a close eye on that, because if we see a surge in terms of energy prices, then that's likely to come most notably within the Eurozone, but it will, of course, impact prices globally. Nonetheless, as we see here, this pop that we're seeing towards the upside is taking us into this interesting confluence where we're seeing a rise into this near-term resistance level, which is the swing high determined in October 2024, alongside this descending trend line. So will we see this rally hold and break through this resistance level, if it was to happen, we'd be looking at a potential wider retracement into one of the deeper levels. You're looking at 8471 or 853 for euro sterling. But certainly for the time being, we're seeing this really strong pop with that weakness within the UK coming at a time where there's a big focus on that surge in terms of borrowing costs in the UK, that weakness of the UK economic story at the moment. And that turnaround is really seeing euro sterling actually gaining ground. Set within a wider context of weakness, we of course have this big hurdle, and whether we break or whether we respect it is going to likely lay the foundations for price action in the weeks to come. And certainly this UK inflation report will be key to that. So in terms of the expectation for rates at the UK, at the Bank of England, we can see here expectation that we do see a cut in February, 64%. And so if we see higher inflation data coming through, then we're likely to see a weakening of that case and therefore a potential move. Let's get rid of that. A potential move towards a hold once again. Will that strengthen the pound? That remains to be seen, but certainly historically that would be the case on a perception of a sort of tighter monetary policy at the Bank of England versus the ECB. The first rate cut beyond that, you're going to be looking at a potential move maybe at sort of the back end of the year, but certainly the expectations from the Bank of England have been shifting significantly away from a raft of cuts, similar to that we're seeing over in the US. And so this inflation report is going to be really key in terms of determining whether that's justified or not. So let's jump onto the US outlook. Bear in mind, of course, we've got the US core PCE inflation metric that is separate to this, and that's generally what the Federal Reserve likes to use the most. But nonetheless, we're likely to see volatility around this inflation report with the CPI numbers coming out, 2.7 on headline, 3.3 on core. And so when we look at the breakdown in terms of inflation, we can see that the past couple of months in particular, but certainly when we're looking at the core number, we've been seeing pretty strong numbers for the past 4 months. So we've been seeing a sort of reflation move coming into the fore over in the US. And so as you see with the 7-month annualized, we're sort of, if you look at that middle section here of the chart, the right looks very similar to the left, whereas previously you were looking at, okay, once that first 6 months of 2024 strips out, then we're likely to see major disinflation. That looks less likely now, but we're still on track to get below that 2% target in terms of headline inflation. That core reading is going to be more difficult though. So as we see here that we're stripping out a relatively low figure from last time around, sort of 0.2, 0.3s. And so there's a question mark around, how much are we actually seeing inflationary pressures build? Because a lot of it is coming down to an expectation under Trump rather than reality itself. That being said, the most notable recent release came out of ISM with the services PMI reading, seeing a sharp rebound in terms of the prices paid element. And bear in mind, services will remain absolutely key. There's all this talk about Donald Trump's tariffs bringing inflation to the country. That may be the case. But in actual fact, under Donald Trump, we didn't necessarily see a huge amount of goods inflation. And the problem hasn't been goods inflation. It's been services inflation. We can see that here. Services inflation in a blue line, it has gradually been moving towards the downside, but goods inflation pretty much non-existent. So as we see under Donald Trump previously, with that gray zone, we can see that goods inflation, we saw some swings, but we didn't see a protracted move towards the upside. We saw it in negative territory, we saw it in positive territory. But by and large, there wasn't just a consistent upward move in terms of goods prices. So that ISM reading really does provide a significant warning that we could see a resurgence in terms of services inflation alongside that latest non-farm payrolls release. A move towards the upside when we were expecting to see it moderate back into the sort of 150s kind of mark. Instead, we moved higher yet. So the US economy is clearly in a good position, and Joe Biden's passing it over in a very strong position. That is providing the basis for people to think that we're going to see strength and potentially higher prices. This is the ISM PMIs when you look at both manufacturing and the services numbers, and both move towards the upside. Manufacturing moving back towards that 50 threshold, GDP looking very healthy, certainly when you compare it to the likes of the UK. One breakdown that we can see here in terms of the different underlying metrics within the US CPI report, you can see here that notably the top two lines are sort of the most problematic, and that has been shelter, which is around about a third of CPI. So shelter prices generally have been very lagging to move. So if you look at the sort of peaks, the peak for shelter is far removed from the peaks for all the other ones that we've got here. So it's a slow turning beast here that we're looking at, and that should hopefully provide the basis for further downside to come. And certainly if rates remain elevated, which they're looking likely to be, then there's a hope that that shelter inflationary pressure turns into disinflationary pressure. And hopefully, even if we do see upside in terms of inflation and other parts of the economy, hopefully shelter should help mitigate some of that. But it's still elevated, as you can see, above all the other ones that we're looking at here. And then we're looking at services excluding shelter, 4.1, and a move towards the downside of late. If we can continue to see downside inflation in terms of services, that's going to be absolutely key. But there's a caveat. We've already seen what happened with the ISM prices paid element, right? So is this indicative of a resurgence in terms of services inflation? That's going to be absolutely key, and it's going to be an element that we're really focusing on quite heavily within the CPI report. So many of these metrics are moving sideways, but I would say the two sort of big areas, problematic areas, have been services as a whole and shelter, or services without shelter, right? So essentially services and then shelter. Shelter falls within services. So those elements, if we see those continue to move towards a downside, even if we see an upside move in terms of inflation, that's at least going to give me a little bit of confidence, considering there's this big fear that we're going to see a move towards the upside for shelter once again. This is overlaying the sort of monthly trajectory of US headline inflation over the price of crude oil. And it's notable because we've seen a bit of an uptick recently in terms of crude, but we haven't necessarily seen that much of a strong move. If you put it in this sort of context, it's more sort of moving into the midway of its range. And so, you know, maybe that provides the basis for a little bit stronger reading in terms of the headline CPI, but it doesn't really point towards a really strong one just off the back of that energy element. In terms of market expectations, what we've seen between that ISM prices paid figure from the ISM services PMI alongside the strong US jobs report, we've seen a pricing away from a lot of rate cuts, essentially away from, well, not even a lot, away from 2 rate cuts, away from 3 rate cuts, and instead towards either no rate cuts over the next year or over 2025, or 1 rate cut. So certainly markets are getting a little bit carried away with this idea that inflation's back and that we are not going to see any move from the Fed, essentially. I think there still is the basis for inflation to have, you know, be kept under control, but it really comes down to what Donald Trump comes in, right? He's got to take it seriously. And the fact that he has supposedly, or that the Republicans are weighing up this idea that they're going to impose a 2% tariff, and then that ramps up unless they sort of strike a deal, you know, then that points towards a possibility that maybe these tariffs aren't necessarily going to be something that's going to be permanent in nature. It's going to be something in the short term, and they could be relatively low, and then a deal gets struck, and, you know, it's not suddenly on day one putting on a 20% tariff or something like that. So that provides the sort of notion to me that they're thinking heavily about inflation. I think they will be well aware of inflation, and also this idea that they're going to borrow a huge amount of money to spend. You know, not so long ago, there was this idea that Donald Trump's essentially going to sort of fast track approvals for businesses willing to invest $1 billion into the country. And so this highlights how there can be pro-business, pro-growth measures that are undertaken without necessarily spending a load of money yourself. It can be through approvals for businesses that want to spend money. So they're going to have to find ways of growing the economy without pushing inflation higher. Part of that could come down to trying to drive down energy prices. And there's talk of Donald Trump very swiftly after getting into office, having a conversation with Putin. And certainly if we were to see a deal that ends the war in Ukraine, then again, that puts a potential for downside on prices. But all of these things are if, buts, and maybes. And we need to see when Donald Trump comes into power exactly what he does, because if he does start to enact measures that are not going to be inflationary, then the current perception around this resurgence in inflation could fade. So, right now we're talking about 0 rate cuts for the course of this year. That might not necessarily happen, but we're seeing some warning signs. Very strong jobs market. We're seeing that strong ISM services PMI prices paid element. So inflation resurgence, that's going to be the key theme for Wednesday. And if we do see those strong monthly inflation numbers and it does point towards a resurgence coming into play, then it's likely to be more of the same. When we're talking about more of the same when it comes to the US, that means more strength for the US dollar. This is the dollar index, as we can see here. From the wider perspective, you can see this breakout from the zone here with a break through this zone down here, essentially leaving that period behind. Let's just try and cap the bottom here as well. There you go. So we've left that behind now. We're essentially in clear air, right? So we have got plenty of room to move into, and we're looking out for near-term trends, right? So you just move down through the time frames, and here we go. This is going to be the more reliable area to be looking out for the trends within it, right? So we know that the trend is very bullish. You see intraday moves, and then you'll see the wider pullback that essentially negates the intraday move and retraces that wider move, and then we get going once again. So at the moment, you can see the intraday move will be highlighted on the hourly time frame. So at the time of recording this, you could say, okay, we're looking at a retracement here, 76.4, absolutely on the nose. We've now started to move towards the upside with the 15-minute chart will highlight. So you can see lower high, lower low, then the higher high, the pullback into, that's probably another 76.4 fib. There you go. So pull back into 76.4. We've swiftly recovered it. So good chance we do continue to move onwards and upwards from here. But if we do see a breakdown through this 109 level, essentially, then you're looking at that wider 4-hour chart to come into play. Let me just get rid of that. No, and that. Let's go with that. So then you're going to be looking out for a wider move to come into play, 1086, 1088 for those deeper retracements. But for the time being, I would say that move within the 1-hour time frame is going to be key. And certainly if we see, as markets are expecting, a potential 0.4 figure on that inflation gauge, and in particular, if we see a surge in terms of those services elements, that's going to be a big problem, and that could provide the basis for further strength going forward as people start to price even less rate cuts over the course of the next year. It's not that many left to start pricing before we start talking about rate hikes. But certainly, I think a lot of it's going to come down to what happens in, roughly a week's time, less than a week's time, when Donald Trump comes into power. And it's likely that he's going to have a lot of things ready to go when he gets into power. And the direction of travel for his new policies should hopefully inform us exactly whether the current perception and fear around inflation is justified. For the time being, all we have is inflation data itself, and therefore we'll be looking very closely at this data to gauge whether the recent concerns around a resurgence in inflation are justified or not.